Good evening, everyone. Welcome to our Long Beach Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks for taking time out of your busy schedules to be able to join us for this workshop. Our workshop tonight is going to run about an hour. It's typically a very interactive session, so we really encourage questions as we roll through tonight's content. This is designed to help educate and support first-time home buyers, so you have all the resources you need to really start the home buying process and really understand what you need to do. So as we roll through tonight's topics, you can use the chat function within Zoom. And what we're going to do is, as we get questions that come in throughout the night, I'll go ahead and share those back with the audience. And those are probably some of the same questions that you as audience members are thinking about as well too. So let's go ahead and dive right in. And just a quick little bit about me, and then we'll talk about our talking points tonight. But so I'm the branch manager with American Pacific Mortgage, and I get a chance to be able to educate first-time home buyers all across the country. We have multiple states that we work in, teaching classes just like this and preparing first-time home buyers, helping them be educated on what it looks like to take the next steps in home ownership. So we really concentrate a lot of our efforts around first-time home buyer assistance and support. And we work within partnerships like this. So many of you have got a chance to connect with us for tonight's class through our Long Beach Alumni partnership. And so we do classes like that for designated alumni that we partner with, and get a chance to share all this great news about what's going on with home ownership. So here's some of the talking points for this evening. So we're going to look at the housing market today. I really think there's a lot to talk about there, and that's also going to include around interest rates and what they look like right now. I'm sure many of you are probably, as you're preparing for tonight's class, you're probably looking at what's going on with interest rates and maybe checking out Zillow and Redfin. So we'll comment on some of that stuff tonight. We're going to do a rent versus buying analysis in just a few minutes, and then we'll look at credit and how credit can impact us for home buying. And then kind of within credit, we're going to look at student loans and how those are determined for qualifying for a mortgage. We'll spend some time looking at loan programs, how as lenders we qualify your income, especially when you had maybe short-term employment or maybe part-time employment. We'll take a look at that stuff. We'll spend some time looking at first-time homebuyer assistance programs. So we get a chance to partner with CalHFA, which is the housing finance agency, and it's designed to help support moderate as well as low-income housing households in home ownership. So we're going to spend some time looking at the product suite for CalHFA. And then we'll wrap up tonight's discussion looking at the loan process of buying a house. So what does it look like to go from a class to get to a consultation to get pre-approved all the way to getting the keys to your house. So we'll kind of look at that tonight. And then finally, we'll talk about a consultation and look at the differences between a pre-approval and a pre-qualification. Okay, so lots of good stuff we're going to spend some time looking at this evening. Again, if you have questions as I'm rolling through tonight's content, please stop us using the chat and we'll go ahead and answer some of those questions live on air. So when we think about home buying, it's probably going to be one of the largest investments we make in our lifetime, right? So it's much more different than going out and buying a car or, looking at another big investment. It's going to be one of the largest decisions you make in your financial future. There's a lot of great benefits that come with owning a home, including, the stability or affordability of a house versus paying a rent that maybe rent's going to increase over time. The ability to be able to pass along the asset to heirs of your estate. Growth in equity. So equity is created by the value of the home versus what you owe on the first mortgage. And there's still some great tax benefits that come along with home buying. Okay, so a lot of good things that come along with home ownership. And so as we get kind of started on this path towards home ownership, a great place to kind of figure out where we should begin is by doing a budgeting exercise. So we're gonna take a look at a rent versus buying calculator, and that's sponsored to us by Freddie Mac. And so Freddie Mac, as well as Fannie Mae, has ownership rights over most of the originations created in the United States. And so this tool that Freddie Mac has on their website, I think it's a great place to get started in the process. So what we're going to do is spend some time looking at some different kind of side-by-side comparisons, but we want to kind of build out our scenario first. So what this calculator is going to ask for is a few things. So we're going to put in our monthly rent. So I'm going to add, say, $2,500 in rent as kind of a what if. And then we're going to have monthly renter's insurance that we want to factor into our budget. We're going to make the assumption that our rent's going to maybe go up 3% a year. So as we sign a new lease agreement, maybe another 12 months, that lease or the monthly amount's probably going to go up by about 3% per year. And then let's look at some purchase prices. we have a little lower price here because we're doing a calculation for a lower price market, but I'm going to go ahead and use 500,000 just for tonight's purposes. And then the minimum down payment when we purchase at 3%, which you're going to learn a little bit more about programs in just a minute, is 3%. Okay. And then property taxes on $5,000 roughly will probably be somewhere in the 6,250 range. And property taxes are going to vary based upon where we decide to purchase in California, for that matter. Homeowners insurance, we're going to estimate that around $1,000 on an annual basis. And then we also want to carve out some expenses for maintenance in our budget. So if we maybe decide to purchase a lower or maybe a property that needs a little bit more TLC, we want to maybe budget maybe a little bit larger for our maintenance cost. And then let's look at loan information. So we're going to assume a 30-year fixed mortgage. We're going to put in today's interest rates. So there is rates as low as 5% for some of our low-income housing families. But we're going to just, for an average interest rate right now, I'm going to put in 5.625%. And then this next line item is going to be origination charges. That's what a lender typically will charge. Now, as American Pacific goes, we have a couple different charges, but the two kind of key origination charges are a processing fee, which is $910. And what's really great about our partnership with Long Beach State is that by utilizing us for your financing, that processing fee drops from $910 to only $160. And then the other fee is a $995 underwriting fee. Okay, so that's what we would see under origination charges. So that's what 19. So we got 1915 roughly. We'll say 1915 in origination charge. I'm going right off the top of the head here. And then we're not going to put any discount points, but let me explain to you what discount points are. So discount points allow you as a buyer to buy down a lower interest rate. And typically 1 point equals 1% of your loan amount. So let's say I'm financing $400,000. If I pay 1 point or 1%, that's $4,000. That would go towards buying down my interest rate. Typically 1 point will equal a 0.25% reduction in interest rate. Okay, let's go ahead and add in a few other assumptions. Now we also want to put appreciation rate in for our home. So hopefully our home will appreciate over time. Now, as the market is trying to settle a little bit, our appreciation rates are starting to slow down, and that happens with real estate cycles. We're going to assume, just to be on the more conservative side, that we're at a 3% appreciation, and we're going to say that we're going to be in the house for the next 7 years. We're also going to add in selling costs for the home. So what's really important as buyers is, as I go out and maybe start home searching, there is no cost for me to utilize the services of a realtor. However, when I turn around and sell my house, maybe 7 years from now, then I would incur costs for the realtor commissions for both the buyer's agent that brings the buyer to my house, as well as the listing agent that represents me as the seller of my home. Typically with those costs, as well as closing costs to sell a house, we're going to factor in about 10% of the price of the home. That we have state and federal taxes that we're going to compensate for, and then we put in a savings rate of 1%. So what happens when we put all that data in here? The calculator comes back to us and says, well, if we look at our payment schedule, so right now from a rent perspective, we're going to pay about $2,500 a month in rent, increasing 3% annually over time, versus my mortgage payment is going to be about $1,400 high. It's $3,983 per month. So we know we're going to increase our monthly outgo. However, by buying instead of renting, my opportunity is about $59,000 in between my appreciation and all my tax benefits over 7 years versus continuing to rent. So as you can see here, we're going to pay $222,878 in cost of renting as rent goes up 3% over time. But if I decide to buy, my total buy costs are about $163 over that same 7 years. The difference being that my appreciation in my home, as well as my tax benefits for owning my home. So when we think about home buying, it's not necessarily an apples to apples comparison because there's a lot of great benefits that come with owning a home. And so when you're thinking about your budget, if you're paying $2,500 a month in rent right now, it's not going to equate to $2,500 a month in home ownership. So that's why I really encourage our buyers to kind of do a little bit more due diligence when it comes to kind of looking at their budget, maybe what you're willing to sacrifice to be able to become a homeowner. Maybe there's some expenses that we're able to cut out of our budget. But at the end of the day, we want to make sure that home buying is going to be affordable for us and something that's sustainable over time. Okay, so that's our rent versus buying calculator. We're going to jump back into our slideshow, and now I want to spend some time looking at the housing market. For those of you that are attending tonight's class, you're probably maybe on Redfin, or perhaps you're on Zillow taking a look at home prices, and you may start to see some homes that are starting to set on the market a little bit longer. Or you might see notice that there's a price cut that those homes have been taking. And we are starting to see more of that activity in the housing market. Now, I want to kind of pause that for a second and then look back a little bit at our housing market. And so let's go back to 2020. We all know kind of in 2020, we had the start of the pandemic. And, this gray line here on this graph represents that. And as we kind of entered in the pandemic, we didn't quite know where the housing market was going to go, but certainly the result of what has happened to the housing market is just a rapid appreciation, which is represented here. What led to that was a few different things. One is, we all know interest rates were at the lowest levels we've ever seen. We had limited inventory available on the housing market, but then we also had kind of a changed work environment where we had many clients that are now able to work from home that don't necessarily have to commute. So maybe their buying decisions looked a little bit different. So that really created a frenzy of buying, but we had limited inventory. And as we all know, with supply and demand, if you have limited supply, high demand, you start to see prices rise. And certainly that's what this graph reflects. Now, we do see a little bit of a change going on right now. And we're starting to see this, if we kind of push this graph out a little bit, we're starting to see a little bit of a flattening. Now, it does depend on what market we're looking at, but this kind of does an analysis of LA, Orange County. Okay, we had a question that came in. Oh, do we have a question? No question. Okay, I saw our alert, the question came in, but I'll kind of finish my thought. So as we kind of see this graph, so it's starting to flatten out a little bit, right? And so we're starting to see homes sit on the market a little bit longer, seeing price cuts. All that is showing a little bit of a softening in the market. Interest rates are playing a role in that because now buyers qualifying is looking a little bit different. Some clients that maybe were pre-approved at 500,000, maybe with the interest rate adjustments, feel more comfortable at 450. So we're seeing kind of a natural settling in the market because the pace that we were on here for the last 2.5 years just was not sustainable. And it made it very difficult for first-time home buyers to get into the market. I mean, I can't tell you how many buyers we have that have been on the sidelines for the last 2.5 years, but now things are starting to shift quite a bit. We're seeing a lot more first-time buyers be able to enter the market. Now they're having to readjust or recalibrate their purchasing power, but I think it's all kind of a good adjustment because now we're seeing homes that are kind of on, a little bit more affordable, although interest rates, as we're going to talk about now, aren't necessarily as favorable as they were over the last 2.5 years. Now, when we look at interest rates, because that's going to play a role in what it looks like from a budget perspective for us, we've really seen a pretty big uptick in interest rates. And so as we look at this chart right here, and we're going to pay most of our attention tonight on this blue line, this blue axis here. So as we move through this chart, and you can see this year, we've seen just a rapid uptick in interest rates. Now, we saw them kind of fall back down, but interest rates shot up really fast over like about a 3-month span of time, right around February. And we really kind of hit our peak just about mid to late June. Most recently, we're starting to see interest rates try to climb back down a little bit. They blipped up yesterday. Now they came back down again today. So we're going to have this kind of choppy market. And really what's kind of driving to that, we're seeing obviously the inflationary concerns we have, concerns around a recession. And one of the things that gets thrown out a lot is when the Federal Reserve is making adjustments in the federal funds interest rate. In fact, we had a 0.75% interest rate hike that was announced just last week. A lot of people think that translates to mortgage interest rates upticking, and it doesn't necessarily have that. They don't correlate because mortgage interest rates are controlled by the bond market. And so we're really looking at what mortgage-backed security market is doing. And actually, mortgage bonds made an improvement after that Federal Reserve announcement was made. So the thing that when we think about the federal funds rate being increased, it's going to be more so directly impacting credit card rates, auto loan rates, lines of credit, things like that. It's not a direct correlation with mortgage interest rates. So that seems to be a bit of a disconnect in the marketplace. So the thing that we want to kind of watch is what's the bond market doing. The 10-year treasury is always a great index to take a look at because that's a pretty good reflection of where we see mortgage interest rates going. So if that 10-year starts to fall, which it's been hovering just underneath 3% as of late, that's going to be kind of something we want to pay close attention to as we're kind of scanning what interest rates are doing. So the takeaway here is interest rates are starting to come back down a little bit. Do we know if that trend's going to continue? We're not quite sure, but certainly they're not at the high levels that we saw back in June. Now, one thing I just want to kind of back up and just speak on really quick is the other lines represented on this graph are for a 15-year fixed mortgages, which is the green line here. And then the red represents the 5-year fixed and or what we call an adjustable rate mortgage. Adjustable rates aren't designed for first-time home buyers. They're going to be more for our second and third-time buyers. And as we're in a higher rate environment like this, a lot of buyers will mention the opportunity of an adjustable rate. And one, we don't think it always makes sense for some of our buyers, but in this market right now, we don't have much of a separation when it comes to 30-year mortgages versus, say, an adjustable rate. And we're entering this place, we call that the inverted yield curve. And we're just not seeing the typical gap we would see between a short-term rates and long-term rates in a rising rate environment like this. So, we'll see what kind of things play out as we get further down the road here in 2022. But right now, adjustable rates, they just not really that much of a make sense as it compares to the long-term rates at 30-year fixed. But as first-time home buyers, our focus is really going to be on the 30-year fixed mortgage product. Now, all interest rates are not created equal in terms of the characteristics that going into selecting an interest rate. So it's based upon credit eligibility. So there's basically different FICO tiers for your selected interest rate. There's loan products that can change the different types of interest rates, how much I finance, what my down payment is. So whether I'm putting 3% down or 20%, that could change the level of interest rate, the cost that I want to pay to obtaining a certain interest rate. So I may have a friend that says, hey, I got a 4.5% interest rate. And you're like, great, that's awesome. I want to get a 4.5% rate. But maybe what you didn't know is that they had to pay an additional 2% of the cost of their loan to be able to obtain that interest rate. So the buzz is to usually have a lower interest rate, but what's really important and we want to understand is like, what's it going to cost me to obtain that interest rate? And those costs are called points. Again, a point is 1% of our loan amount, and typically 1 point will lower your interest rate 0.25%. Okay, finally, last thing that kind of goes into interest rates that can influence interest rates is the term of your loan. So generally speaking, there's 30-year mortgages, 20-year, 15, 10. I think you can do as low as a 5-year mortgage if you want to. Generally, the lower term you get, the cheaper your interest rate will be. So if you went from a 30-year mortgage that's say at 5.625, maybe a 15-year mortgage is at 5%. Okay, so that's what it looks like. And what we want to do as part of a consultation with you is to design a financing option that makes the most sense for you, given what your goals are with home ownership, and to select the right interest rate and kind of program setup that works best for you. So one of the biggest components to getting the best available interest rate is to make sure we're in a good spot from a credit perspective. Credit is not only going to influence our interest rate, but influences our program options, as well as a thing called mortgage insurance, which you're going to learn a little bit more this evening. So let's take a look and dive into credit. And the first place we want to start is our FICO score calculation model, because this kind of shows you how FICO scores are made up. And many of you on tonight's call have some type of monitoring system, whether it's Credit Karma, Experian, TransUnion, what have you, which are all great tools. And I think they give you a nice roadmap to get in improved credit and how to manage your credit. This FICO score, the way it's weighted, I think it's important to understand so you can kind of maximize or optimize your credit. So 15% of your credit score is how long you've had credit. So the more mature my credit file is, potentially the higher my credit score is going to be. 20% is going to be how much new credit I have in use, or new credit I'm trying to obtain, i.e. credit inquiries. Those are hard inquiries. So the more accounts I have newly established, the more credit I'm trying to get access to, then that's going to start to lower my credit score. So that's 20% of the weighting. Now there's a difference between hard inquiries and soft inquiries. So hard inquiries can impact your credit score. Soft inquiries give a lender access to be able to view your credit score. And there's a rule for credit or hard inquiries in that for the auto industry and the mortgage industry, once you've started day one of your credit inquiry, you have a 30-day window of time to shop around with as many lenders as you want to see what your different options look like for credit resources. Now, if you decide to connect with us for a consultation after tonight's class, we only start with a soft inquiry, so that doesn't impact your score. We just want to get a sense of where you're at from just an obligations perspective and how your score maybe matches up to some of the available programs. 30% of the FICO score calculation is going to be how much you owe on your revolving credit balances, also known as credit utilization. We want to try to get that credit utilization as low as possible. What credit utilization looks like is if I have $10,000 in credit limits and I have $5,000 in credit balances, that means I'm at 50% utilization, okay? Ideally, we want to try to keep our utilization below 10% of that credit limit amount. So that means I would want to be below $1,000 in balances. One of the things we recommend in managing your credit balances is to try to pay off or pay down your credit card balances before the end of the billing cycle date. And here's what that means. So if my billing cycle date is on the 20th of the month, but my credit card payment is actually due on the 4th of the month, then if I'm paying off the credit card balance on the 4th of the month, what's going to happen is that balance that was still reported on the cycle date, if it's on the 20th, that still goes out to the bureaus, even though I paid it off my due date, and that's going to negatively impact your utilization. However, if I decide to pay that off or pay it down before the 20th, like let's say the 19th, then ideally I'd have a zero balance that gets posted out to the credit bureaus, and then I have lower utilization, higher credit score. So that's a great way to kind of manage your credit cards if possible. I know it's not always achievable for everybody to pay off their balances, but if you can try to keep that utilization as low as possible and make those adjustments before the billing cycle date, you'll get that improved score. Final thing is payment history, and that's pretty self-explanatory. The better we pay on our credit cards and other accounts, the better our credit score is going to be. If you've had some past challenges like late payments, they're rated in 30, 60, and 90-day delinquencies. Okay, so the higher number of days I have delinquent, the more impact you're going to have to your score. Now, past challenges like late payments are generally going to be the most impacted on your score in the most recent 12 to 24 months from the event. So if I had a late payment in October of 21 and now we're here August 22, still inside that 12-month period, probably hurting my credit score a little bit more. But as I get beyond, say, 2 years from that event, maybe I get out into late 23 or 24, I probably should see some kind of improvement in my credit score. Every program that a lender offers, like American Pacific Mortgage, we're going to have minimum credit scores to obtain those products. Okay, so FHA has a minimum score of 580, conventional loans at 620. So conventional is for Fannie Mae or Freddie Mac type loan. VA loans for our veterans is 620. And then the CalHFA first time buyer assistance program is a minimum score of 640 for FHA, 680 for the conventional product. And we'll talk a little bit more specific about products in just a minute. Couple other footnotes here, account closure for revolving accounts. So really try to avoid, if you're in the habit of doing balance transfers, the old account that you have, try to not close out that account, because when you close out that account, it pulls away all the most recent history from that account and can actually negatively impact your credit score. And as lenders, when we're evaluating credit score, we always look at what we call the middle score between all three bureaus. So there's three agencies that report. There's TransUnion, there's Equifax, and there's Experian. So if I'm applying for a mortgage, for example, and I have a 720 score, 700, and 680, as a lender, we're going to take the 700 score for qualifying purposes. Now, let's say I'm applying with my partner, and my partner's at 680, 660, and 640. As a lender, we take the lowest middle score between both applicants. So in that case, 640 would be the score that we would utilize for qualifying purposes. Okay, this matrix here kind of shows you how long maybe past challenges will be on your credit report. So hard inquiries, 2 years or less. We want to avoid multiple inquiries, especially in the last 6 months. That's where going to give you the kind of biggest hit to your score. Late payments will be on your credit report for 7 years, but the impact is in the most recent 12 to 24 months, as you heard earlier. Maybe bankruptcy, state tax liens, those are all 10 years or less. Federal debt, whether it's a tax lien or student loans, are going to be on your report indefinitely. Okay, so really important if any type of federal debt, we want to make sure it's resolved. Now, speaking of federal debt, like federal student loans, all of us that do have student loans and they're federally backed, they are in forbearance right now. So there's no payment required. However, as a lender, we do have to have a qualifying payment entered for the mortgage financing. So generally for clients that have, let's say, an income-based repayment prior to the pandemic, so let's say I was on an income-based repayment amount of $250 before the pandemic and the CARES Act implementation of the forbearance. The $250 payment is what I would use for my qualifying for my mortgage, as long as I had documentation for that. Now, if I maybe graduated during the pandemic and I don't quite have a payment program yet, then if we're doing an FHA loan, we would default to 0.5% of the balance as the monthly payment. And then for a conventional loan, it's always 1% of the balance for the payment. So if at all possible, it's great if we can be on an income-based repayment amount, because that's what's going to probably give us the lowest available payment and really maximize our qualifying. Now, if you're on a 0 income-based repayment amount, we can use that. That's absolutely fine. But for the most part, all federal student loans show as 0 right now, even if you're on an income-based repayment or not. So that's why we'll kind of go through that payment exercise with you. If you're on deferment because you're back in school, maybe you're finishing up on your master's program, there still has to be a minimum payment that's counted for student loans. Okay, any questions on student loans or credit before we move into our next topic? Okay. And I can always come back to some of the stuff we've already reviewed, whether it's housing market, interest rate questions or whatnot. So feel free to let us know. Again, just go ahead and use the Q&A and then we can jump in there and answer that question. Okay, let's go ahead and transition over to loan programs. As you heard earlier, each loan program has minimum credit score requirements. So these are kind of the 5 core programs that we're usually going to be working from and designing a home buying plan for you. So there's the conventional loan, which has a minimum down payment of 3%. FHA is a minimum of 3.5%. VA is going to be no down payment. So for our veterans that have served, we can have a loan structure with no minimum down payment. There's USDA loans, that stands for the United States Department of Agriculture. Those are going to be for our rural areas. Some of our desert cities will qualify under USDA. So there's only a specific geography that'll work for that product. And then there's jumbo loans. And that's going to be for our clients that are looking to maybe purchase at the higher end of the market. So usually loans that stretch beyond $970,800. So, and that requires usually a minimum down payment of 10 to 15%. Okay, so I'm gonna just pause for a second. I just got a quick question that came in. The question was, if we want to apply with my wife who doesn't have credit history because she has just come back to the USA, will they use her 0 credit for qualification? So that's a great question. And so let me just kind of rephrase the question. So if I'm applying with my partner and I have credit, but my partner doesn't, how as a lender would you look at that? So in lending, for most products, each borrower would need to have a credit score. That credit history generally needs to be at least 12 months of credit history. For conventional loans, they're going to be the requirement, 12 months of credit history and a credit score that appears. FHA does allow borrowers that don't have credit at all, so no credit score, to do what we call as non-traditional credit. And what that means is, instead of having your typical Visa, MasterCard, American Express that appears on your credit, we can use alternative credit like not homeowners insurance, but auto insurance, some type of utility payments, cell phone bill, things of that. Okay. All right. Hopefully that answers your question. We had another question that came in, what is FHA? And that's right on cue, because I'm going to answer that question right now. So let me just first continue the thought on jumbo loans, just so you can understand the difference between jumbo and some of the other products that we're going to talk about. Jumbo loans are going to be for clients that are purchasing in the higher end of the market. So like you can see here, larger loan amounts. And with that said, there's additional assets that are usually required with jumbo loans. Not only do we need to save up our down payment and closing costs, but we're also going to need some additional what we call as reserves for assets. And those take the shape of either 401ks, 403bs, brokerage accounts, of course, checking and savings accounts. And what reserves are, it's assets we have left behind after we've contributed our down payment and closing costs. Usually the asset requirement is going to be 12 months worth of your mortgage payment in assets. So if you had a $5,000 mortgage payment, times that by 12, you would need an additional $60,000 in assets in addition to what you have saved for your down payment and closing costs. Okay, I'm going to answer one more question, then I'm going to kind of finish up our product set here. So question came in, if neither, so the question came in just around credit, which was if neither borrower has credit, are there alternatives? Really, if neither borrower had credit, then we would have to look at non-traditional credit through the FHA product. And like I said, non-traditional credit would be, utility bills, cell phone bills, car insurance that we can verify at least a 12-month payment history, because products are going to require some type of 12-month history. Let's take a look at those products. So conventional loans are going to be a minimum down payment of 3% for first-time buyers like ourselves on tonight's class. 5% is going to be the down payment requirement if we want to finance more than $647,200. And what that $647,200 represents is the conforming limit for loans. Anything above that for LA and Orange County is going to be a minimum down payment of 5%. Now, FHA loans, and we had that question come in. FHA loans are going to be not just for first-time buyers; they can be for second and third-time buyers. It's for it stands for the Federal Housing Administration. So it's a product that allows people to purchase with as minimum as 3.5% down. So it's a little bit higher than a conventional loan, but 3.5% down is whether you're a first-time or second-time buyer. That goes all the way up to a loan amount of $970,000, $800,000 as well. Now, the $647,200 mark is the conforming limit. Anything above that is called high balance, and that's why that minimum down payment jumps from 3% to 5%. Now, when we look at the products, there's different credit score requirements for a conventional loan, 620 for a conventional, 580 for FHA. And of course, as we talked about, there's no score requirements available through FHA as well, if you're looking at non-traditional credit. But when we look at these products and their kind of characteristics, there's a kind of a key difference when it comes to what we call mortgage insurance. There's a thing called private mortgage insurance that comes into play when we put less than 20% down. And so for conventional loans, if we put that less than 20% down, the mortgage insurance will be required. So, and typically mortgage insurance is going to be paid either for a monthly basis, a split MI, or single premium, which, and let me jump back for a second. Split MI is going to be where I can pay some of it up front. I can pay some of it monthly. And then there's single premium where I can basically buy out the mortgage insurance in its entirety, and then lender paid mortgage insurance. And what lender paid mortgage insurance does, it allows you to take a slightly higher interest rate in order to buy out your mortgage insurance. Now, a question came in through the chat, which was, is there mortgage insurance on VA? So VA loans do not have any mortgage insurance. So it's 100% financing. But what VA loans do have is what we call a funding fee. So depending on what your eligibility looks like, or if you've ever used your VA in the past, then you would have a corresponding funding fee. If you have any percentage of disability through the VA, you can potentially have a complete exemption from your funding fee. But generally speaking, if you have a standard certificate of eligibility, the funding fee will be usually 2.4% estimated of your loan amount. Okay, and that gets added into your amount financed. Now, mortgage insurance on conventional loans has three key characteristics that make up the premium for mortgage insurance. It's based upon your credit score. It's going to be based upon what your down payment is. So if I put a larger down payment and I have a higher credit score, and depending on what I finance, that will give me a certain mortgage insurance premium. Okay. And I'll answer this question in just a second. We got another question that came in. I want to kind of wrap up with mortgage insurance. So with mortgage insurance on a conventional loan, there is a cancellation option, which is a key differentiation between that and FHA loans. When you have at least 2 years in the loan and 20 to 22% equity, you can apply to have the mortgage insurance canceled on a conventional loan. This is kind of what a conventional loan PMI scenario looks like. So if I financed 450, I had a score of 740, and I decided to put 3% down, the monthly mortgage insurance is going to be about $183 per month. Now let's look at FHA, because it looks at PMI quite a bit differently. So there's two different components to PMI for FHA loans. There's monthly mortgage insurance, which is 0.85% of your loan amount. And there's upfront mortgage insurance, which is 1.75% of your loan amount that gets added into the mortgage insurance or to the loan amount. Now, with mortgage insurance on an FHA loan, it cannot be canceled once you reach the two-year time frame. It's for the life of the loan, the full 30-year fixed period of time. So the only way you can cancel mortgage insurance is if you refinance into like another conventional product or whatnot. Now, when we look at that same scenario for FHA PMI, the 450 loan amount will have to add on the 1.75% for the upfront mortgage insurance. Then we have monthly PMI, which now is $324 per month, so a lot higher than what we would face in conventional loans. And then the $7,875 gets added on top of the loan amount. So you may kind of step back for a second and say, well, why would I choose FHA? Because mortgage insurance is more expensive. It also has the upfront mortgage insurance and I can't cancel it. Well, everybody's financial situation is a little bit different, and FHA has a little more leniency within their guidelines that would allow someone to maybe utilize that financing versus conventional. There's different seasoning requirements for things like foreclosure, bankruptcies, short sales. For example, if I've had a past bankruptcy, FHA only requires me to be out of that bankruptcy 2 years, where conventional would allow me to, or have me out for 4 years. Or if I had a past foreclosure, for example, conventional would want to see 7 years versus FHA is 4 years. So all those little differences will kind of have a client go one way or the other, and credit score plays a big factor in that as well. So we had a question that came in again about VA loans. And the question was, instead of just putting 0% down for a VA loan, do I have the option to increase my down payment to 3%? And you can absolutely increase your down payment to whatever amount you want. Some clients would want to put 20% down, even though it's a VA loan. So you as a buyer have that option to kind of customize your financing based upon what you're looking for. Okay. So we talked a little bit about the conforming loan limits. Here's what they look like for all of our Southern California counties. So LA and Orange County are all the same because those are the higher cost of living markets. Riverside and San Bernardino are both going to be the same at the conforming limit. So that'll take us to that 3% down payment. And then we have Ventura and San Diego. So anytime we go beyond 647, 200, and we're in one of those higher cost of living markets, then that minimum down payment would jump to 5% on a conventional loan. Okay, any questions on any of that material so far? Okay. All right, so now we're going to kind of transition out of loan programs. I want to spend some time talking a little bit about qualifying income and some of the documentation that you'll need in preparing for home buying. So as a W-2 wage earner, generally the documents we would ask for is the last 2 years of W-2s, your last 30 days of paycheck stubs, and then we'll have to verify your employment. Usually it's done written as well as verbal for the verification. Now, if we're self-employed, it depends on how our tax structure is, but usually we're going to want the last 2 years of tax returns, both your individual filing or your personal filing, as well as your filing for your business. So if you're a sole proprietor, you're going to have a Schedule C with your personal tax returns. Or if you're an S Corp, C Corp, LLC, we would need those 2 years of tax returns. With financing and being self-employed, we're going to probably need at least 2 years of history of the business and to be able to verify that. And that verification comes within like a business license, CPA letter, because we need to be able to show that the business is sustainable from an income perspective. Now, a couple questions that come up in clients that are completing their applications and going through their consultations. which is, do I have to have like 2 years full work history to be eligible for a mortgage? And you don't have to have 2 years mortgage or work history. You can have a combination of education and work history to be able to get qualified. So the example I use is, let's say I went to Long Beach and I finished up with my accounting degree, did undergrad for 4 years. Now I just got hired on at Deloitte. Well, I've had 4 years of undergrad and now I'm going to work right in the field of study. So that would fulfill my 2-year requirement. So that would be absolutely okay for financing. Another question comes up is job change. So let's say I got a new job, bigger, better job, but I'm not starting that job for 30 days. However, I have an executed offer letter. If I have that offer letter, you can provide it to us. We can utilize that to verify what your income is going to be and base your financing around that. Now, you'll have to start your job and receive your first paycheck before your first mortgage payment is due, but we can still use that as potential income for your qualifying. If you're working more of a part-time job, we do have to show that you've been on a part-time job for 2 years. So if you have multiple part-time jobs, I was just talking to a client earlier today with a scenario like that. And we have to show that you demonstrated that you've been working in those part-time capacities for 2 years to be able to utilize the qualifying income. Now, if you have dual employment, so this happens a lot in the healthcare industry. Let's say you're working for one clinic 30 hours a week, 20 hours in another clinic. As long as I can demonstrate that I've been working in both of those jobs for 2 years consistently, then we could potentially use that for qualifying income. And then finally, if you have W-2 employment, but then let's say you have self-employment income. Let's say I drive for Uber on the weekends. If I want to count my Uber income, then I need to show that I've been not only working my W-2 job for 2 years or in a W-2 job full-time for 2 years, but I'm working the self-employment income as well simultaneously for the last 2 years. Okay, so kind of sticking with income, I want to talk a little bit about a calculation that we use as lenders. It's called the debt to income ratio calculation. It takes into consideration your pre-tax or your gross income versus your monthly obligations. And we don't want that percentage of obligations to consume more than 45% of our pre-tax income. Now, there's some variance to that, but that's kind of the general thought. Now, that indicates qualifying for financing, but doesn't necessarily indicate what the affordability looks like. And so as we walk through a consultation and do a one-on-one with you over video, we'll design options for you that are hopefully going to be affordable for you. And so we'll have that conversation of, what it looks like to go from $2,500 in rent to a $3,500 mortgage payment. And is that going to be suitable for you with your budgeting? But debt to income ratio will give us a little bit of help from a qualifying perspective, but the real conversation is going to be around, what does that feel like when we jump up to that $3,500 per month? Here's the formula for debt to income ratio. So these acronyms here, PITI stands for the principal and interest, property taxes, and the insurance of my home. PMI is going to be for the private mortgage insurance, like we talked about earlier. HOA is going to be for our homeowners association dues if we buy like a condo or townhouse. So let's say that's $2,500 a month. And then if we have other debts like auto expenses or maybe personal loan or student loans of $500 a month. So if my total obligations are $3,000 a month and then my pre-tax income is $8,500 a month, then my debt to income ratio is somewhere around 35.29%. Now, for most of our first-time home buyers, their debt to income ratio feels pretty comfortable. And I think that the sweet spot is 33 to 36%. But everybody's situation is a little bit different. So that's why we encourage clients to get connected with us so we can kind of figure out what that looks like for them in designing a home buying plan. Okay, so now we're going to transition now out of income. Let's talk about documentation for down payment. And so when we look at the acceptable sources of down payment, of course, checking and savings accounts will work. Cash will not work. So you have to have everything paper trailed in a home mortgage or a home buying transaction. Any large deposits that we've had in our bank account, those all have to be paper trailed. You can still use retirement accounts. So 401ks, 403bs, we'd ideally like to use other options, but those accounts can be used. IRAs can potentially be used, but you really want to talk to your tax advisor, maybe your financial planner about if that's a good use of those funds. And then gift funds can be used as well. And that's where a family member could help out with both our down payment and our closing costs. There's a way we have to kind of track those funds. The donor's going to have to complete a gift letter at times may have to provide proof of their asset statement and confirmation of the transfer, but gift funds can absolutely be used. Gift funds do not require a seasoning requirement. All other assets will have to be seasoned for 60 days, but gifts funds are one of the things that do not need to be seasoned. So as we meet with all of our first-time home buyers across the state, there's usually kind of two things that get in the way of home ownership and maybe not being totally ready to purchase. It's usually just maybe not in a good spot from a credit perspective, maybe have a little bit too much in obligations, trying to get things settled financially, or two, just lack of resources for down payment. Maybe we got a great job, we just graduated, things are going good, we got our income, but we just haven't got a chance to really save enough because we just haven't been, in our careers long enough. And so the assistance programs that we work in partnership with CalHFA can be a great way of bridging that gap for you to home ownership. So that's what we love teaching these classes, to be able to kind of share with you different resources that are available to you. So now we're going to talk a little bit about first-time buyer assistance, and there's a couple different paths we can go down with first-time home ownership. And so let's start talking a little bit about the products. And we're first going to look at the moderate income products, and then we'll spend some time looking at the low income housing products. And I'll show you what the difference is from an income perspective with those different products. So the first one is the My Home Assistance Program. And on a conventional loan, that provides up to 3% of your purchase price that counts towards down payment. For an FHA loan, it's 3.5%. Both of those options are low interest loans at 1%. And they're not required to be paid back to the state until you either sell your home or if you decide to refinance early in the future. Okay, so that can help with your down payment. And then, as we learned earlier, I've talked a little bit about assets and how we need down payment and closing costs saved. The ZIP zero interest program can help out with closing costs, where you can get up to 2 to 3% of your loan amount interest-free that can count towards those closing costs, and you don't have to pay that no interest loan back until you sell or refinance in the future. Now, the way it works with these programs, you would have to first take the My Home Assistance Program, utilize those funds, and if you still need additional funds, you could kind of add on the zero interest program. So great way of getting some additional funds to help lower the cost of your home purchase. Now, there is income limits that are required on these programs. So here's the income limits by county. These just went up this year. In fact, I think is this our latest, or I think we maybe have another version of this. I thought, okay. So we have we'll send you guys the updated version. This is the limits just went up over the last 3 weeks. So I think LA is now at 180. And I believe Orange County's pushed closer to 230,000. So we'll get you guys updated numbers for that. And so when we look at this program and how it can benefit us as first-time homebuyers, I want to kind of take you through a scenario so you could see how you could apply the use of these funds. So let's say we took a $500,000 purchase. Now, we all know that the minimum down payment from tonight's class is $15,000. So I'm going to need to say $15,000. And then closing costs vary. And, I would say closing costs are usually going to be on the high side of probably $15,000, usually 3% of your purchase price. That's kind of what we're seeing in the market right now. So I'm probably going to need about $30,000 saved to buy my house. Now, if I take advantage of the CalHFA assistance program, what's great about this program is I can still buy my same $500,000 house, but instead of having to save up that $15,000 for the down payment, now I can take the My Home Assistance, utilize $15,000 through that program, and offset what my down payment could be. So now I've reduced my out-of-pocket to, let's say, $15,000 for just my closing costs. And then if I still need additional help, I can add on the ZIP assistance to help offset the remaining cash through those closing costs. And that allows our home buyers to be so much closer to home ownership, because the average first-time home buyer that comes to us usually has about $10,000 to $12,000 saved. So it takes quite a bit more to be able to obtain home ownership. And so that's where I think CalHFA is a great opportunity to bridge the gap. FHA, the channel through FHA for CalHFA can still do the same thing, because if I qualify on FHA, the minimum down payment is 3.5%. My Home will kind of add in that support to cover that down payment. And then we can also, just as the same theory applies with the conventional loan, still add in ZIP assistance to help lower the closing costs out of pocket. So another great way to help us get into home ownership. Now, for FHA loans, the minimum the minimum credit score is 640. For the conventional loan on that moderate income product is 680. So that helps our moderate income families. Now, the other product that was just launched, and many of you may have seen it, it was in KTLA, I think. I did a piece on this. We've seen it in our Bay Area markets, in the San Jose Mercury, and that is the Forgivable Equity Builder program. And we've been lucky enough to be able to help so many clients, probably the leading provider of just this program in CalHFA, throughout the last month or so that it's been launched. And what it does, it allows low income buyers to be able to utilize the Forgivable Equity Builder program and get up to 10% of their purchase price or appraised value in assistance that can count towards their down payment and their closing costs. And it's a fantastic program. It's designed to help support low income housing families, which is an individual that makes less than $78,320 for the Los Angeles area. And so that's a product that, while the income limits are not as high as the other product, but for those that do fit this criteria, can be an awesome opportunity to help really provide a significant amount of help towards the down payment and closing costs. Now, it can't be combined with the My Home or the ZIP program, so it has to kind of stand on its own. But it goes with the CalHFA conventional and the FHA product. There is minimum credit score requirements on this product as well. So it's 640 for FHA. It's only 660 for conventional. For the moderate income product, it's 680. So let me just kind of back up for a second. 640 for the FHA loan, whether you're on the low income or moderate income. For conventional, minimum score of 660 for the Forgivable Equity program, if you are eligible. 680 for the moderate income conventional product. All these programs that we talked about do have a maximum debt to income ratio of 45%. Okay. So a question just came in, is the 80% of AMI for the individual or for the same for married couples? So that's a great question. So I was going to actually bring that up. So the income limits are going to be based upon the individual applicant. And so whoever applies on the loan, it's the total of their income. So if I make, $70,000 a year and my partner makes $50,000 a year, but I'm only going to apply in just my name, then it's only my income that's going to count to the qualifying. Okay, and that holds true for not only Equity Builder program, but for the moderate income program as well. Okay, and then first-time buyer status, just so we understand, first-time buyer is not necessarily somebody that's never owned. It's someone that hasn't owned in the last 3 years. So, you may have owned back in 2010 and sold the property in 2012. Well, if you haven't owned a house and you've been renting for the last 3 years, you're considered a first-time buyer. This program is going to be applicable for different types of properties, which include single-family homes, new construction homes, condos, townhomes, below market properties. Those are all eligible. Now, manufactured homes are eligible, but they cannot be in like mobile home parks. They have to be on land that's actually owned. So there's a big difference there. And then Ken's just posted the income limits, the current version from the CalHFA website, so you have that for your reference too. Okay, and on our social channels, we always post updates on CalHFA as well as some of the different resources that are changing. We'll talk more about our social channels later on tonight, but that's a great way of get up-to-date information on what's kind of happening with first-time buyer programs. Okay, so now we're going to talk about the home buying process, and this is our kind of our visual tool for our buyers to understand like the different milestones we're going to go through in home buying. We call this our 6 steps of home buying. And the first step is going to be our pre-approval, which is basically the output, the plan that comes out of our consultation that we do with you. We'll talk more about a consultation in just a minute, but a pre-approval is a certificate that you'll have as a buyer that allows you to make offers on a home. Usually that pre-approval is good for 60 days, but if it takes you longer to find a house, there's no rush to find a house in 60 days. We can always recertify your pre-approval at any time. Now, there's a difference between a pre-qualification and a pre-approval. Let me tell you the difference. The pre-qualification is where I've just submitted an application and my credit has been run, and then the pre-qualification is issued. A pre-approval is not only the application and credit, but we also verify your assets and your income, and of course the program that you're utilizing. Many online lenders will use a pre-qualification process, which honestly doesn't hold up much in today's market because it still remains super competitive, and even though we're seeing a little bit of softening. So we always encourage our buyers to take advantage of a pre-approval. And quite honestly, the only thing we do with our team is just pre-approvals. That seems to work the best across the different markets we service. Okay, so pre-approval is going to be the output of a consultation. We know our pre-approval is going to last for 60 days. Now our next step is house hunting. That's where you get a chance to look at different homes. You're probably going to start off with an online search. Usually a realtor will help build a portal for you that has all the kind of the filters of what you're looking for in a particular property. Realtors who can help you with the house hunting process are paid for by the seller, as we learned earlier. And we do have a fantastic network of preferred realtors. So if you do need help in the home shopping phase of things, we can always get you connected as kind of one of our resources after a consultation. So we've gone pre-approval, house hunting, and now as we're getting a little bit more serious about our house hunting, we decide to make an offer on a property. Now that offer gets accepted by a seller, and that begins the escrow process. And that's also step 3 of the process. And that's super exciting times because now you have a seller that's accepted your offer. But there's a lot of activities that start to take place. First thing is we're going to give you a call to congratulate you on your accepted offer, schedule you for a follow-up consultation over video, where we get a chance to, kind of show you the design of your financing, make sure you understand where current market interest rates are at, talk about your total out-of-pocket, what your assistance program is going to look like if you elect something like that, and really just have everything kind of positioned for you on your financing. Now, part of your contract will include the requirement of an earnest money deposit. You'll generally have to make that deposit within 2 to 3 days of your accepted offer. Now at step 3, we also on the lending side start ordering the appraisal of the house. We're going to talk a little bit more about that in a second. And your realtor will order inspections of the house based upon, what you feel like you want to have kind of checked out. Because as you start step 3 in the process, you're also starting to do your homework on the property. And finally, we're going to issue to you initial disclosures once we've completed your follow-up consultation. That kind of shows you the full outline of your elected financing. Question just came in about, does a pre-approval lock in your interest rate? And that's a great question. So a pre-approval does not lock in your interest rate. We do have programs that allow you to lock in your interest rate at pre-approval, but on the CalHFA assistance program, if that's something you're interested in, that we can't lock in that interest rate until you actually have an accepted offer and reach step 3 in the process. Okay, so at step 3, you're going to have to make an earnest money deposit. That deposit is usually 1 to 2% of your purchase price. That amount will vary based upon where you're going to buy in California. If you're joining us from the Bay Area markets, what we quite often see is that the minimum deposit is usually like 3%. So it can be a little bit higher based upon the market that you're choosing to purchase in. Now, as part of your contract, there's usually stipulations called a contingency period. And that allows you to do your due diligence on the property, get a chance to get the house inspected, get your house appraised, which is going to be conducted, the lender ourselves at American Pacific would order that. Your realtor would order the inspections, and then we would get your loan approved. The contingency period is usually in the first 14 and standard 17 days of your contract. So usually by default, it's 17 days. Sometimes it can be short as even 10 days. And why that's an important time period, because it allows you to do the homework on the property and have your deposit completely protected for you. Now, while those activities are going on, we're starting the processing and underwriting of your loan. Those are the administrative functions of the loan. We're getting everything prepared to go to the underwriting team. We probably have your rate locked by that time. So we'll talk about locking in your rate at your consultation at step 3. But before we get to step 4, you should be locked in. And we're going to get everything submitted to our underwriting team. And our underwriting team will issue in a loan approval at step 5. That basically says that an underwriter has reviewed all of your financials and says that you're eligible for the financing. It's also going to bring you to the end of your contingency period. So if you feel comfortable with your inspections, your appraisal, of course, your loan has been approved, then you're going to give the okay to your realtor to sign off on your contingencies. And that basically, that sign off tells the seller that you're comfortable in moving forward in the process and you feel good about all the work you've done behind the scenes checking out the property. Now, it's important to know that once you've signed off on your contingencies, you're also telling the seller that you're ready to go to the final stages of the process. So if you sign off on the contingencies and then a few days later you just get second thoughts, you could risk losing your deposit. So you want to really be careful with that final signature on your contingencies. Question just came in about the contingency period. So I'll share that again with you guys. So contingency period is by default 17 days from the day one of your contract. It can be as short as 10 days. So some sellers want shorter contingency periods for whatever reason, but by default, it's 17 days. And the last couple things that are going to happen at step 5 is we're going to issue a final closing disclosure to you. That basically shows you all your locked in final terms of your loan, interest rate, payment, out-of-pocket expense. There really won't be any surprises at step 5, but it does provide you a 3-day cooling off period to make sure you just feel comfortable with the setup of your financing before we get to the very final stage, and that's called closing your loan. And closing your loan is when you get a chance to sign final documents. Those are in person with a public notary. That process usually takes about an hour, maybe hour and 15 minutes. And you're reviewing all the final terms of your loan. Now, that requires a live or a wet signature. Everything up to that point can be done via e-disclosure. So, but that's one of the one things that has to be done in person with the notary. After you've completed those signings, you'll wire in the final funds for your purchase. If there's any funds coming from like an assistance program, us as a lender will handle the wiring of that. We do a QC process, which takes about 24 hours after you're signing, and then we wire in the funds for the financing. Now, those funds get collected by an escrow team. They make sure that everything is balanced. So you as a buyer contributing what you're supposed to in the transaction, the seller's receiving the funds that they expected. And once that's all completed and balanced, then your loan is released to the county recorder's office for recording. They're going to record a grant deed, and that transfers ownership to you from the seller. They also record a deed of trust, which is your agreement to repay the loan. So once all that gets recorded, then you become the official owner of the house. You get a chance to get a great call from your realtor, coordinating your key delivery, and then you get a chance to high five and get a chance to share with your family all the great news of home ownership, because it's a big accomplishment in our financial lives, and we want to celebrate that huge accomplishment right there with you. So now we mentioned something about a consultation. So a consultation is the chance to put together a game plan to figure out what home buying can look like for us. It's usually about a 30-minute session. We go review your interest rate options. We look at the loan process, different payment scenarios, out-of-pocket expense, and we design that plan. And then the output of the consultation is the pre-approval. So, that's something we really encourage you to get connected with us. All the information for our consultations right here at step 2. If you have some questions as maybe follow-up from tonight's session, we can do intro calls, and those are like 10 to 15-minute sessions with myself or our team to just maybe answer any follow-up questions that you might have. Question came in, and I'm just going to read this to the group. So in the past month, sellers have been asking buyers to waive inspections. Would APM finance a loan where inspections have been waived by the buyer? So great question. So there is no restrictions on the lender APM requiring you to have a contingency or not. So it's completely a buyer choice whether you want inspections, loan, or appraisal contingencies. We recommend it, but it's not a requirement for financing. And I will say, to kind of add on to that, we're seeing the market change, and sellers are not having the leverage they did have. And we're seeing, contingencies becoming more of a norm, not necessarily having to waive like we saw, over the past previous 2 years. Now, if you want to schedule one of those intro or consultations, all the information's here to be able to schedule that. For a consultation, we do require you to complete your online application, upload the documents that you can see here, as well as, of course, schedule the consultation. The consultation is usually done over video, and those are one-on-one sessions with me. And like I said, that's an opportunity to design a home buying plan for you. Here's the framework of a consultation, going through the housing, your housing location that you're looking at, affordability, what's the different aspects of your application. We'll talk about interest rates, closing costs, all that fun stuff. And we certainly want to review the 6 steps of home buying again. Okay, and Ken just included in the chat the links to the consultation if you guys need that as well. Now we have some other great resources available to you. We have our mobile app. So if you want to apply for your financing, if you want to do some calculations, if you apply and you move forward in the process, the mobile app will actually push notifications right to your phone. So a really great tool to help you in the home buying process. I can't tell you how many clients over the weekends when they're out looking at homes use the calculator. I think it's a great tool for you to use as a home buyer. Now, as you heard earlier, we're thrilled to have our Long Beach State Alumni Partnership along with athletics. And so we pass along a discount program to the alumni and affiliates with the university, which is a $750 discount on closing costs. So that $910 processing fee drops to $160. We want to just provide that value to you beyond all, I think, with these great workshops that we try to produce for you. And the consultations that we do for you are absolutely free. So there's no expectation around that. We just want to help guide you down the path of homeownership. As I mentioned earlier, when I opened up tonight's discussion, it's probably the largest investment you're going to make. So we want to be a partner with you to help kind of take you down that path towards homeownership, whether it's next month, next year, or maybe 5 years out. Hopefully this information will be helpful for you to be able to get you into homeownership at some point. If you're not part of our Long Beach State partnership, we're still glad you tuned in with us. We have other partnerships as well. So if you're affiliated with one of these universities or maybe even state employee, there's also those discounts available to you too. Here's our upcoming class schedule. If you thought this information was super helpful and you want to share that with a coworker or family member, they're more than welcome to attend our next class, which is going to be August 9th. That is for kind of more of the Bay Area, San Francisco market, but it's just about the market data. If you're in LA and you want to attend that class, all the kind of same curriculum's the same. All right. And then just to kind of wrap us up, you heard me talk a little bit about our social channels. Really encourage you to follow us on Instagram. Check us out on Facebook. We'd love to, I should say, post all of our testimonials on Google. Sorry, let me back up. We love our Google reviews and Yelp reviews. A lot of great testimonials out there, especially a lot from our graduates of these classes over the last 6-7 years that we've been teaching classes. So we're really proud of what our clients are saying about us in our local communities that we service. If you want to get connected with me after the workshop, this is all my personal contact information. Feel free to reach out to me, message me, call. And like I said, you can schedule an appointment with us. Lots of great things that we're doing to help our communities in homeownership and hopefully get a chance to help you in the future as well. So we're going to get a chance to hang out online for a little bit. I know we had a lot of great questions tonight. We're going to stay live for a few minutes longer if there's some things that got missed. And then I'll go ahead and answer those questions on live before we disconnect. Okay, so we had a question came in, and the question is, are consultations free? Yes, consultations are absolutely free. And that's, we want to be a resource for you. So whether you're buying next month or next year, at least you can kind of know what your home buying plan looks like. Okay, any other questions out there? Okay, so we got one more that came in. So question came in, I'll just answer it live. So one of our audience members already submitted pre-approvals through other lenders, but would like to see what options we have with our team at APM, which is fantastic. We love that. And they want to know what the starting point should be. So if you've already done that, I would recommend doing the Get Started, which is the online application, uploading documents and doing a consultation. Intro calls are great, but I think, it would be great to learn a little bit more about you financially so we can design some plans for you and see how things compares with some of the other options that you're looking at. Okay. All right. Well, I think we're good. Looks like we went a little bit over our time tonight, but I think, we had some great questions, really great engagement from our audience. Appreciate you joining tonight's class. Again, if you have other, friends, family, coworkers that want to check out one of our upcoming classes, they can see our class schedule on the slideshow or visit us at mortgageeducate.com. And you will be getting the presentation material tomorrow as well. So, all right, have a great evening. We'll talk to y'all soon.